Welcome to the deep dive. So, 2025, huh? It's feels like the investment world is trying to breakdance on a trampoline lately.
Yeah, that's a good way to put it. Volatile.
Definitely. Interest rates are doing the cha-cha, the AI market's acting like it just mainlined espresso,
hmm
and, global trade feels about as smooth as a gravel road.
hmm
Even those investments who are supposed to be the grown-ups in the room, Treasury bills are barely keeping their head above the inflationary water.
Right.
And some of those solid dividend payers are suddenly singing a different tune, one with, fewer payouts.
Yeah, dividend cuts are definitely a concern.
It's enough to make you wonder where to find some solid ground.
That sense of instability is definitely prompting investors to look beyond the usual suspects for more reliable returns and maybe lower volatility.
Which brings us, I think, perfectly to today's exploration.
Yeah.
We're diving deep into an area of the market that, well, it often gets a polite nod and then gets passed over.
Yeah.
Preferred stocks.
Ah, yes.
The minivan.
Exactly. Think of them as the dependable minivan of the investment world. Not flashy, but consistently gets the job done and keeps things relatively smooth. They're this sort of hybrid creature, right? Sitting somewhere between stocks and bonds. And they're known for their steady dividend payouts.
The minivan analogy works pretty well. Reliable, practical,
Yeah.
and often underestimated. They definitely occupy a unique space.
Exactly. Now, I know what some of you might be thinking, preferred stocks. Aren't those just kind of boring?
Well,
And you know what? On the surface, maybe they don't have the roller coaster thrills of the latest tech darling or the perceived safety blanket of government bonds. But that boring nature, as it turns out, that can be a real advantage right now.
it really can. That consistency is appealing.
It's precisely why they're starting to look a lot more interesting, offering a potentially steadier income stream and, frankly, a less bumpy ride than some other options out there. That search for consistent income with less volatility is a major theme we're seeing, yeah. And preferred stocks are certainly fitting that bill for a growing number of investors.
So our mission today is to really dig into this. We want to understand why preferred stocks are gaining traction in the current climate, drawing on some really insightful analysis we've been reviewing.
Okay.
More importantly, we want to help you decide if they might have a place in your investment strategy, giving you a clear understanding of this asset class without getting totally lost in the financial weeds. Okay, let's unpack this. What's behind the growing appeal of preferreds in 2025?
Well, several factors are kind of converging to create a more attractive environment. First off, the yields available right now are genuinely compelling,
Like how compelling?
often in the 6% to 9% plus range.
Wow, okay.
And this elevated yield is partly a consequence of the interest rate hikes we saw, over the past couple of years. As rates rose, the prices of existing preferred stocks generally declined, creating opportunities to buy them at a discount and effectively pushing their yields higher. That level of consistent income is, well, pretty significant when you consider the challenges of finding decent yield elsewhere.
Right, a substantial income stream can really change the picture, especially when other income-generating stuff isn't performing so great.
You mentioned those rate hikes. How does the current interest rate environment play into this?
Yeah, so the fact that we appear to be approaching the peak of the Fed's rate hiking cycle, the so-called terminal rate,
Yeah.
that's generally a positive for preferred stocks.
Okay, how so?
Well, they faced headwinds during the rising rate period because their fixed dividend payments became less appealing compared to, say, newly issued bonds offering higher yields.
Makes sense.
Now that rates are expected to stabilize, and there's even some talk of potential rate cuts, the soft landing scenario everyone's hoping for, the uncertainty that weighed on preferreds has diminished quite a bit, making them look more attractive again. So the very rate hikes that caused some pain might now be setting up a better landscape for them.
Interesting. You also mentioned buying at a discount. This sounds like a key part of the story. Can you tell us more about that potential upside?
Yeah, absolutely. So many preferred stocks were originally issued when interest rates were much lower. These often have a stated face value or par value, typically $25 per share.
Okay, $25.
Right. But because rates went up, you can now find some of these same preferreds trading on the market for prices like, say, $18 to $22.
Oh, okay. So below that par value.
Exactly. So if the issuing company eventually calls these preferred shares, that just means they redeem them at their par value of $25 or if they mature at that price. You stand to gain not only from the attractive dividend yield you receive while holding them, but also from the capital appreciation as the price moves back toward that $25 par value.
So it's potentially a double benefit.
Essentially, yeah.
Yeah.
Income plus potential capital gain. Double win indeed. Income while you hold and potential profit down the line. That certainly adds a layer of excitement to the whole boring hybrid thing.
What about taxes? Any silver linings there?
Well, for the majority of qualified preferred stock dividends, the tax treatment is generally the same as for common stock dividends, meaning they often qualify for lower tax rates compared to your regular income, which can definitely enhance your overall after-tax returns.
Always good news. Now, another interesting point from our research is that preferred stocks tend to sort of march to the beat of a different drum than the tech sector. Why is that?
Absolutely. Preferred stocks, particularly those issued by companies in more, let's say, established sectors like financials, utilities, or real estate.
Okay.
They generally exhibit a lower correlation with the often volatile technology sector. So if the high-growth tech market takes a dive,
Which it does sometimes.
which it does, your preferred stock holdings in other sectors might remain relatively stable and just keep generating their dividend income.
This provides a really valuable diversification element to your portfolio, potentially smoothing out your overall returns, especially in times of, sector-specific craziness.
That's a really important point, especially with all the buzz around AI right now. It's good to have some anchors in the portfolio that aren't necessarily tied to the latest tech trends.
Huh.
Okay, let's get into some specific examples that our source highlighted.
Yeah.
First up, Bank of America Preferred Series L, ticker BAC-L. What makes this one interesting?
Okay, so BAC-L currently offers a yield around 6.2%. What's particularly noteworthy here is its fixed to floating rate structure.
Fixed to floating. How does that work?
It starts with a fixed dividend rate, but at a set point in the future, it'll switch to a floating rate that's linked to some benchmark interest rate.
Okay.
So if short-term interest rates stay high or even go up, this could actually lead to an increase in the dividend payment later on.
Oh, interesting. Built-in potential upside.
Exactly. Plus, Bank of America is considered too big to fail, which offers a degree of stability. And importantly for income investors, BAC-L is non-callable for a certain period.
Meaning they can't just redeem it early.
Right. They can't just snatch back your income stream prematurely. It also tends to have relatively good trading volume, making it easier to buy or sell compared to some less liquid preferreds.
Okay, so you've got a solid yield, potential for higher payouts if rates stay up, from a big bank that's probably not going anywhere, and they can't take it back early. That does sound appealing. What about Public Storage Preferred Series G, ticker PSA-G?
Right. PSA-G yield is around 6.5%. The rationale here really centers on the inherent stability of the self-storage business.
Right. People always need storage.
Exactly. Regardless of the broader economy, people accumulate stuff and often need a place to put it. Public storage has very strong financials. The author even called it fortress-like.
Fortress-like, okay.
Suggesting a lower probability of dividend cuts or, financial distress impacting their preferred shareholders. It's a business that tends to weather economic storms relatively well. Think about it, even in a downturn, people still need to store their junk.
The people still hoard in recessions argument. It's surprisingly logical. A business somewhat insulated from the ups and downs.
Yeah.
Okay, next, Wells Fargo Preferred Series Q, WFC-Q. Yield about 6.8%. Now, Wells Fargo has certainly had its share of challenges in the past.
Yeah.
What's the thinking here?
Yeah, that's a valid point about Wells Fargo's history, no doubt. However, the argument presented is that the bank has made pretty significant strides in addressing its past issues and is, currently in a more stable, maybe less volatile position. Its sheer size and interconnectedness within the financial system also suggest a lower risk of a complete collapse. The author even makes a sort of tongue-in-cheek remark about their likelihood of getting support if needed.
Right.
So while past performance is never a guarantee, the current stability plus that relatively attractive yield are the key factors being highlighted here.
Okay, so a case of maybe past issues being behind them, with size and yield the main draws now. Got it. Let's shift gears a bit. Digital Realty Preferred Series K, DLR-K, yielding around 7.4%. This one connects to that AI narrative we mentioned earlier, right?
Precisely. Digital Realty is a REIT, a real estate investment trust that owns and operates data centers.
The infrastructure.
Exactly.
Yeah.
The critical infrastructure that underpins the internet and, crucially, all the AI development and cloud computing happening. The idea here is you get exposure to that AI growth through a more stable asset class than, say, the often super highly valued pure AI stocks themselves.
Okay, so less direct, maybe less risky.
Potentially. The preferred stock offers a significant yield from a company that's pretty essential to the digital economy. It's a way to potentially benefit from the AI trend without the extreme valuation risks you might see elsewhere.
That sounds like a potentially less volatile way to play a major growth trend.
Interesting.
Okay, finally, New York Mortgage Trust Preferred Series E, NYMTN. Significantly higher yield here, around 9.5%. Our source called this one a dive bar. So what's the higher risk, higher reward thing going on?
Yeah, that higher yield on NYMTN definitely signals a higher level of risk. New York Mortgage Trust is a mortgage REIT, or MREIT.
Okay, MREIT.
And that sector can be more sensitive to swings in interest rates and credit market conditions. The dive bar analogy suggests, yeah, it's not the safest or most pristine option.
Right, not exactly top shelf.
Yeah, exactly. But the justification provided is that the company has been actively working to improve its portfolio management since the market blew up during COVID.
Okay.
And crucially, as a preferred stock, it still holds a higher priority over common shareholders when it comes to getting paid dividends.
Still ahead in line.
Right. So while there's a greater potential for volatility or maybe even a temporary dividend suspension compared to the others, that much higher yield represents the potential reward for taking on that extra risk. It's a clear risk-reward trade-off within the preferred world.
Okay, so a higher potential payout, but you might have to navigate potentially choppier waters. It's useful to see that range from the more stable to the, well, dive bar end.
Definitely.
Now, our source also tackled some common hesitations people have about preferreds. Let's hit those. First, illiquidity. Are these hard to buy and sell when you need to?
Well, it's true that preferred stocks generally don't trade with the same crazy frequency as, say, Apple or Microsoft common stock.
Okay.
This can mean the difference between the buy price and the sell price, the bid-ask spread, might be a bit wider.
Yeah.
And yeah, it could take slightly longer to execute a really large trade without nudging the price.
Right.
However, for the typical income-focused investor who isn't doing high-frequency trading,
Which is probably most people listening.
probably, the level of liquidity in many preferreds, especially from larger companies like the ones we've discussed, is usually quite adequate. The goal here isn't rapid trading. It's that consistent income.
That makes sense. If your strategy is buy and hold for the dividend, daily volume is maybe less critical.
Mm-hmm.
Okay, another concern. Complexity. Are these prospectuses just full of impossible jargon?
You know, while a preferred stock prospectus is a legal document, and yeah, it can look intimidating at first.
Understatement sometimes.
Right. But the key terms that investors really need to grasp to make informed decisions are actually pretty manageable.
Like what?
Things like the coupon rate, that's the fixed dividend percentage, the call date and call price, when and at what price the company might redeem the shares. The payment priority, knowing preferreds get paid before common. Whether it's cumulative, meaning any missed dividend payments have to be paid back to preferred holders before common shareholders get anything.
That's important.
Very. And whether the dividend rate is fixed or floating, just focusing on those core features usually gives you enough understanding. It's about learning a few key terms, not needing a PhD in finance.
Okay, so focusing on those core bits can demystify it. What about the worry that preferreds can take a big hit during recessions? Is that a big vulnerability?
They certainly can decline in market value during big economic downturns, sure. Investors get risk-averse. They might flee to safer assets.
Right.
However, it's crucial to remember that, unlike common stock, a big rebound in the market price isn't strictly necessary for preferred investors to get their expected returns, especially if they bought at a discount.
How so?
Well, if you buy a preferred share at $20, like in our earlier example, and you just hold it until it's redeemed at its $25 par value, you still make that capital gain, even if the broader market stays weak.
Okay. The redemption itself provides the return path.
Exactly. Plus, that cumulative feature we just mentioned offers real downside protection. If the company has to temporarily suspend dividends in a bad recession, they are legally obligated to pay all those missed dividends back to preferred shareholders before common stockholders see a dime. That's a notable advantage over common stock in tough times.
Yeah, that cumulative feature definitely adds a layer of security and sort of aligns the incentives towards the preferred holder. Now, our source used a really helpful comparison between preferred and common using BOVA. Can you walk us through that?
Sure. So if you look at Bank of America's common stock, you'll see it pays a relatively modest dividend yield, right?
Yeah, usually lower.
But its price is super sensitive to tons of factors: earnings reports, economic news, just general market mood swings. It can bounce around a lot, think more volatile.
Okay.
On the other hand, that Bank of America Preferred Series L, BAC-L, offers a notably higher and more consistent dividend yield, and its market price tends to be considerably less volatile.
Doesn't jump around as much.
Right. It doesn't react nearly as dramatically to the day-to-day market noise and company news that can send common stocks soaring or plummeting. So the common stock offers potential for greater capital growth, but with more risk and uncertainty.
Right. Higher potential reward, higher potential risk.
While the preferred stock is primarily designed for that steady income and relative price stability.
Okay, so common for growth seekers, comfortable with swings, preferred for those prioritizing predictable income and a smoother ride.
Got it.
Who then should probably just avoid preferred stocks altogether? And who might find them really valuable?
Okay, so you should likely steer clear of preferreds if your main goal is rapid capital appreciation, like you're chasing momentum, and you have a high tolerance for volatility.
Not for the thrill seekers necessarily.
Probably not. Also, if you need absolutely immediate guaranteed liquidity, preferreds might not be the best fit because of those potentially wider spreads we talked about.
Okay.
If you don't have a basic grasp of how interest rates impact fixed income type securities, it'd be smart to do some more homework first.
Good advice.
And frankly, if the idea of even looking at a summarized prospectus makes you want to run screaming, you might be happier with simpler investments.
Okay, so probably not for day traders or those allergic to financial docs. So who should consider adding preferreds to their portfolio?
Preferred stocks can be a particularly valuable tool for long-term income investors. People who prioritize a consistent stream of dividend payments and relative stability over maybe shooting for the moon with growth.
Right, the income focus.
Exactly. If you're looking for alternatives to often volatile growth stocks and you want a higher yield than you might typically find in traditional bonds right now, preferreds are definitely worth exploring. They can be especially attractive, I think, for retirees or maybe folks in the accumulation phase who are really focused on building a reliable income-generating part of their overall portfolio.
That makes perfect sense for those who value that steady, predictable income and want to maybe dial down the overall portfolio volatility. Now, based on the insights from our source, what are some key strategies for actually building a preferred stock portfolio if someone decides, okay, this sounds interesting?
Right. The author suggests several important approaches. First, diversification. Seems obvious, but really important here across various sectors holding preferreds from banks, REITs, utilities, maybe even some carefully chosen closed-end funds that helps spread out sector-specific risk.
Don't put all your eggs in one basket.
Exactly. Then, balancing credit risk, so including a mix of investment-grade, preferreds those from companies with strong credit ratings, lower default risk.
Okay, the safer ones.
Alongside maybe some higher-yielding, potentially riskier issues like that MRIT example, NYMTN, that can help optimize the overall risk-reward balance.
Got it. Mix and match risk levels.
Third, laddering call dates. This just means owning preferreds with a range of different potential redemption dates. As some get called, it frees up capital,
which you can then reinvest.
Right, potentially into more attractive preferreds available at that time. It helps with capital rotation.
Smart.
Also, selectively reinvesting based on the discount to par. So actively looking for preferreds, trading well below that $25 par value, with the idea of potentially selling as they get closer to par.
Capturing that capital appreciation piece.
Precisely. And finally, closely monitoring the Fed. What the Federal Reserve does with interest rates is crucial. Changes in policy can significantly impact preferred stock values and how attractive they look compared to other things.
Okay, so diversification, managing risk, laddering dates, looking for discounts, and keep an eye on the Fed. Sounds like a pretty prudent way to go about it.
Indeed. The goal is really to create a resilient and dependable income stream within your broader investment strategy.
Well, to kind of bring it all together then, it really seems that preferred stocks, even if they aren't the flashiest things on the block,
Definitely not flashy.
they offer a really compelling mix right now. You've got predictable income, that potential for some capital appreciation if you buy them at a discount, and some favorable tax treatment. All in a market that feels, frankly, pretty uncertain.
Precisely. They might not be the subject of, thrilling dinner party conversations. Probably not. But in an environment where finding stable, reliable returns is a genuine challenge, their dependability holds considerable appeal.
They might not go viral on TikTok,
Yeah.
but as our source put it quite simply, they work, they do their job.
Yeah.
And in a market that sometimes feels driven by pure speculation, that kind of reliable performance has its own inherent value, I think.
I agree.
So here's a final thought for you, our listener. In a world that often seems obsessed with chasing the next big thing, the next rocket ship stock, is there maybe overlooked value in the consistently reliable?
Good question.
What other, perhaps boring corners of the investment world might offer similar untapped potential for long-term stability and meaningful returns? Maybe it's time to look beyond the flashy headlines and appreciate the quiet workhorses of the investment landscape. Thanks for joining us for this deep dive.